What's up, everybody? All right, so today we're going to talk about day trading terminology, and the term of the day is level 2. Now, as a beginner trader, I really didn't know what level 2 meant. So it's, I suppose, no surprise that I get tons of emails every week from traders who are asking, what is level 2? How does it work? How's it supposed to help me trading? How am I supposed to read all of these numbers? Well, level 2 data, you can see this is level 2, or also known sometimes as market depth. Right here. And what this shows us is literally the depth of the market. Whereas traditional level 1 data simply shows us the bid and the ask, in this case 1541 or 1536 by 1543, that alone only tells us the price. That's the only information that we get from level 1 data. Whereas level 2 data also tells us the share size, and it shows us the number of buyers and sellers, both on the bid and on the ask, that are just outside the current level 1 quote. So we've got our level 1 quote, and then we have the depth of the market. Now, by learning to read market depth in level 2, we can start to interpret market sentiment just by looking at these numbers. And that's really important. Every trader needs to have their edge. And for day traders, reading level 2 is part of having that extra edge. If you're looking at just level 1 data and you see, the stock is at 38, well, when you look at level 2 data, you may see that there's a 100,000 share seller at 38. So that would tell you, oh, I'm not going to buy this. That's too risky. Whereas someone just looking at level 1 data is like, oh, I'll jump in this at 38. No problem. They're not going to realize that the stock's not working until it starts dropping. And of course, by that time, you're already out because you saw that big seller. So your losses are smaller, and that's because you were able to read level 2. You were able to, get that early exit indicator, or in other cases, an early entry indicator. So we're going to go over how to read level 2, how to use it, and how it can make you really a better day trader. For me, trying to trade without level 2 is almost like trying to drive with one eye closed. Can I do it? Yes, I can. Does it make sense to do it? No, it doesn't. And really, there's not a single good reason why you would drive with one eye closed. Open both your eyes, use the tools accessible, and level 2 is one of them. This is an important tool for day traders. If you're an active day trader, you should be using level 2. So whether you're a beginner and this is something that you're just learning about, or you're an experienced trader who wants to learn more about how to use level 2, through this video, my goal is that at the very end, you'll feel like you understand the importance of this tool and you understand the basics of how it works. Now, you guys should know this is going to be sort of a Cliff Notes version of level 2, and I'll talk a little bit about level 1. In our full-length courses at warriortrading.com, we go into a lot of depth talking about level 2 and all the intricacies, but we don't have time to do that right now. And of course, it's not fair to do that for the students who join our premium classes. But you guys are going to get kind of the Cliff Notes version, and know that some of this stuff is the tip of the iceberg, and it can get a lot more detailed. So I don't expect by the end of this video that you're going to be able to, profitably trade using level 2 data, but I think that by the end of it, you'll understand how important this tool is, and you're going to want to learn more about it. All right, so with that said, let's jump in here and start talking about level 2, day trading terminology. Now, you can see here, this is pretty much our standard level 2 window. We've got our bid on the left, and we've got our ask on the right. And you can see here, well, that's interesting. There's 3 buyers all at 230. Well, this is the depth. This is showing us that when we see that quote of 230 by 231, that there's more behind that. There's actually 3 people with orders to buy at 230. Whether these are just market makers or they're actual retail traders, we may not know, but there are 3 orders right here. So let's say you're looking at level 1 data and you're like, man, I want to sell 10,000 shares, but I'm not sure if I should. By looking at level 2 data, you can see, hey, there's a 15,000 share buyer right here at 230. So you know what? It's probably safe to sell 10,000 shares because you're going to sell them right to him. But if he wasn't sitting here, if he was gone, then all we have is 100 shares. And you can't sell 10,000 shares to a 100 share buyer, right? So most likely you're going to sell 100 shares to him. This is 0, so that means it's less than 100. And remember, you have to add 2 zeros. So this is 15,500. This is 100. This is maybe 70 or something like that. and as you scroll down. So in this case, if you sold 10,000 and all you have is 100, well, you'll sell 100 to him, and now you're selling the rest to this guy at 28. But remember, with 10,000 shares, every single dollar is $100. So when you're losing, 2 cents because you're not looking at level 2, it's costing you $200. By reading level 2, you can make sure you get the best exit. You can choose to sell when there is a buyer, or you could choose to instead maybe put an order on the ask and wait for buyers to come to you. Now, in addition to seeing the price and the number of buyers and sellers at all of these prices, we also see all of these market makers, and we'll talk about that more in just a moment. So the most important thing for you to understand with level 1 and level 2 data is that every single stock has a bid and every single stock has an ask, right? That is universal. As a buyer, you can choose to put an order on the bid, and you can wait for a seller to come and sell you shares. You're a buyer, you're waiting for a seller to come sell you those shares. Now, when you alternatively want to just jump into a trade, you can buy shares from someone who's selling them at the ask price. You'll pay a little bit more, right? But if you want to get in right now, that's the quick way to do it. One of the things that you'll notice is that some stocks have level 2 that's stacked very tightly, where you have, let's say, the bid at $10, and then the next level is 99, the next level is 98, 97, 96, 95, 94. Other stocks are spaced out a little bit more. So you have a bid at $10, and the next closest bid is like $9.95, right? And then $9.89, $9.74, $9.64. They start to get stretched out. Those are stocks that you can tell if someone goes and sends a 10,000 share order, the stock could quickly drop all the way down to $9.64. Some stocks can move very, very quickly, and others move slowly. And we can understand that simply by looking at the level 2. So in a sense, by reading level 2 and looking at level 2, we can interpret the potential for volatility. Now, as day traders, volatility is our friend. We love volatility. We look for volatility and we look for volume. But volatility is only valuable when we have high volume, and that's going to be the result of a catalyst. So one of the things that we talk about extensively at Warrior Trading is the importance of trading stocks that have breaking news. Breaking news is what brings thousands and thousands of traders, all across the world into the market to buy these particular stocks. That's what creates the high volume. That's what creates the big spikes. And those are the stocks that it's worth looking at and watching. Looking at level 2 data on just any old stock is pointless. We only look at level 2 data on stocks that are very active. So this is a tool that we apply only to the right types of stocks to trade. If you're not sure about the right types of stocks to trade, then we have another video where we talk about that, and you can also see that info on warriortrading.com. All right, so now you'll also notice that, right, some stocks have a thin market, and those are the stocks that are spaced out a little bit more, the bigger intervals. Those are stocks that typically also have bigger spreads. Now, in 2001, I'll give you a little bit of a little backstory here. In 2001, the market underwent decimalization, right? So before that, the market traded in fractions. So stocks would trade in eighths and quarters and halves and stuff like that. Now, that meant the spreads were bigger, right? A stock trading with a quarter spread is 25 cents. An eighth spread is 12.5 cents. Those are pretty big spreads. That was really good for market makers because a market maker creates the spread and they profit by selling shares back and forth across the spread. That's how they make money all day long. Now, for them, market makers, they need to be incentivized to create the market on these stocks, right? And their incentive is that they can profit from doing that. There's obviously risk in being a market maker as well. So, to offset that risk, they have the profit, which is trading stocks across the spread. Now, thinly traded stocks, since decimalization, have seen even bigger spreads because there's less incentive for market makers to make the market on those stocks because they're so volatile. All right. So those stocks, they often have a low float. They're very thinly traded. Not a lot of market makers are making the market. Not a lot of active retail traders have placed out orders. And as a result, those stocks are not very liquid. And that means if you wanted to buy 100,000 shares, you probably couldn't. Not at any realistic price. The stock would move so quickly as you sent that order because there aren't enough sellers there to sell you shares. That means that those stocks, when they have really strong demand, let's say it's a pharmaceutical company and they just have really good clinical trial results. Well, once you have really strong demand, those stocks can move very quickly. In fact, 50 to 100% intraday. And I'm going to show you some videos, some live clips of me trading towards the end of this video, where I'm trading these types of stocks that move 50 to 100%. I have one that even moves 400%. All right, so those are the types of stocks that we watch for day trading opportunities. Now, that gets into a little bit of stock selection and stuff like that, but it also comes back to, thin market or thick market. And one of the things you'll realize as a trader, whether you're a beginner or experienced, is that all of these things we talk about, these are all part of building your foundation. And one block, if you don't learn, one piece of the puzzle, it's going to affect everything else. So building a strong foundation, every single block needs to be solid. You need to understand level 2. Just the way you need to understand candlestick patterns, the way you need to understand, how to choose stocks, how to build a watch list. These are all part of the blocks that make up your foundation. And this is a foundation that ultimately you can use as the launching pad for your career as a trader. We've got traders in our room that are in their 80s. So you could be doing this for the next 30 or 40 years. It's important that, if you're thinking about doing that, you build a strong foundation. So in contrast to a thin market, we've got a thick market. And a thick market is going to be a stock that has a very high market cap and is very thickly traded. Lots of market makers are making the market. They see opportunity to profit. And lots of retail traders may also be trading these stocks as investments. They don't necessarily move a lot intraday. And that actually makes them great vehicles for long-term investment because they're lower risk. But at the same time, that makes them really unattractive for day traders because they're not volatile. So the desires of an investor are almost the opposite of the desires of a day trader. And here, this is the level 2 of Bank of America. The Bank of America float is over my 100 million max threshold. In fact, it's 10 billion shares. It's a huge float. When they did their IPO and they've released so many shares out onto the market that for this stock to move 30%, it would take almost an unthinkable amount of volume for that to happen in one day. There's over 100,000 shares sitting on the bid. Actually, there's over 200,000 shares. That means if someone comes and sells, a 200,000 share order, which is like $3 million of stock, it's not even going to move a penny. Right? That's crazy. But this is the reality of thickly traded stocks. And again, this means an investor who wants to come in with $1 million can get in easily and can get out easily. So there's value there, but not for day traders. For day traders, we look for stocks that can move. So we're going to be looking at the lower float stocks, ideally under 10 million, but anything under 100 million is worth watching. And these stocks are going to have slightly bigger spreads. As you can see here, they're not going to be as thick at all of the tiers. They're going to be a little bit thinner. You've only got one market maker at each tier. And they're also spaced out a little bit, 1110, 1112, 1114. So you've got a little bit more space. And you can realize that it wouldn't take much for this stock to drop from 1115 all the way down to 1080 or maybe even 1050. This stock could drop 5% in a matter of 10 minutes. And that's scary for an investor, but as a day trader, that's attractive. That's potential. All right. So these are the types of stocks we're going to look at. But again, remember, we only trade these types of stocks when they have a catalyst. The rest of the year, we don't even look at them. But the good news is there's 250 trading days in a year, and there's thousands and thousands of stocks on the market. So we can almost always find a stock to trade every single day. In fact, this year, I don't think there's been one day where I haven't found at least one stock to trade. Now, when we're looking closer at level 2, you need to understand what we're looking at. We've got the price right here in the middle. We've got the order size, right? And plus the 2 zeros, so 15,500, 100. And then we've got the market maker. So the market makers, as I said, create the spread by posting both a bid and an ask. They're on both sides of the level 2, both sides of the spread. All right. Now, these are kind of, if you think of this as an island, each of these market makers create an electronic communication network, an ECN. And we can use that as a bridge onto the island, right? This is the island, and these are all the different bridges that we can take, right? To here, to here, to here. Well, just like using a bridge, there's a toll. It's called an ECN fee. and they charge you based on the number of shares that you're passing into the market. And there are some exceptions here with adding liquidity, removing liquidity, where you can actually get rebates. You can actually get paid to send order flows through some of these routes. But again, that's a little more complex. We're not going to get into that right now. So the important thing to know is that there are many different bridges or ECN networks that you can take to get into the market. And you can actually specifically choose which ones you want to use, or you can let your broker choose for you. All right. Now, this is what my platform looks like. My trading platform is a small chart, my level 2, my time and sales. This is showing every transaction that goes through. So while this is just showing the numbers, this is actually showing the orders as they pass through. And then this is my open positions and the trades I've taken. Now, when we jump out of this, and I'll show you just for a moment. This, again, is a very thickly traded stock. This is AKS, and I'll just check here up on... let's see, AKS is how big is this float? This is a very, very thickly traded stock. I'm not sure what the float is. It looks like it's 200. This is my trade ideas window. This is a 235 million share float. So it's certainly not as thick as a stock like Bank of America, which is going to be 10 billion shares, but it's still very thickly traded and too thickly traded for us to want to consider it for a day trade. There we go. It's a little slow there. Now, we'll talk more about the time and sales in a moment, but for right now, we're just talking about the level 2 data and level 2 in general. All right, now you can see here down at the bottom, this is where I can send my orders, and I can choose to short, to buy, my order size, share size, and right here you can see where I've got market. This will send a market order. Well, I actually don't use market orders. I use limit orders, but when I choose this, when I click this button, I'm going to get a drop down of all the different routes that I can choose. NYSE, NASDAQ, ARCA, BATS, EDGX, etc. All of these are available, and I can choose from them. So how would I choose which one to send to? Well, routes, these are bridges onto the island, okay? And a lot of traders like using ARCA. That's one of the most popular. EDGX is also popular. NASDAQ is popular. NYSE, JPCC, Post, these are some others. And you can see here, this is my drop down of all of the different routes that are available with SpeedTrader. And SpeedTrader also lists the various fees for these routes. Some of them are, they charge fees, others will give you credit. They give you a refund, a slight refund. It's not a big one, but if you're trading with large size, it can certainly add up. And then they also have here Smart, SpeedTrader Smart. This is their own custom route. And what it's going to do is it's going to route your order to whichever route they think is going to be fastest. All right. This is an important thing to understand. I personally don't use smart routing. I prefer to direct route my orders. So when I do direct routing, I just go and I click on Edge or ARCA or INET. And I can also use a hotkey to automatically choose these routes. The problem with smart routing, most brokers offer smart routing. The problem to me is that instead of asking you which route you want to send to, your broker is going to route to whichever ECN they feel is best. They may have an arranged discount rate with a certain broker, certain market maker, and use that as the preferred route. That may be good for the broker, but it may not be good for you. You may also run into the issue where the broker routes the orders internally to see if someone inside the brokerage is available to match your order. And then your order doesn't even get sent out to the open market. Now, all of that slows down. That creates latency. I prefer not to do that. I want really fast orders. So what I do instead is just simply direct route my orders to one of my top 3 market makers. ARCA, NASDAQ, or Edge. Those are the 3 that I like a lot. By doing that, the orders may still get rerouted, and I'll show you why that would happen. Let's back up here. So let's say I'm looking here at BATS. Well, you see PSE here on the bid. Well, that's fine. PSE is on the bid, but if I send the order through EDGX, what happens? EDGX is all the way down here at, what is it, 50 or something like that. Does my order go through at 50? No, it goes through at the current best bid. Market makers have an obligation to give you the fill at the current best bid. And that means if they don't have the shares, they reroute it to whoever does. And this all happens very, very quickly. So when you're routing orders, you can choose to not allow them to reroute and send them out somewhere else, which is not smart in my opinion. Or you can let them reroute it. And that way, if you send an order through ARCA, but there's only Edge X, ARCA will send it to Edge X. You send it to Edge X and there's only PSE, they'll send it to PSE and you'll get your fill. All right, that's important. The most important thing here is, when you want to get into a trade that you can get filled quickly. All right, so I don't use smart routing, I just use direct routing. Now, dark pools, right? This sounds ominous. Dark pools of liquidity. Dark pools are like ports on the island that are kind of like, hidden in the fog. Nobody can see them, but they're there, right? And there may be someone at one of those dark pools that's selling 100,000 shares and you want to buy 100,000 shares. The problem is most routes don't check the dark pools. They can't see them, they don't check them. So when you send your order to buy 100,000 shares, even though there may be someone at one of these quote dark pools that have the shares, you're not going to be able to get them, and you're probably going to end up paying a higher price because you're trying to buy from this limited group of sellers that may have the shares. This is a disadvantage for retail traders. Institutional traders, firms, the big brokers, sometimes they trade internally, and so they end up pulling some of the liquidity out of the open market, and they have it almost kind of reserved internally. So one of the things that's really cool is that we can now ping the dark pools. So it's kind of like sonar. Even though we may not be able to see it visually, we might not see it on the level 2, you can send an order to buy a stock or sell a stock. You can send the order in between the spread sometimes. It's a 65 by 68. You can send the order at 66 in between the spread, and sometimes you'll get filled because there is someone out there that has an order at 66 on the dark pool. You just can't see it here on sort of the front-facing level 2. So dark pool routing is a pretty cool thing, and this helps us, especially if you're trading really large size. If you're trading 1,000 shares or 500 shares, it's not going to make a big difference. But when you start trading with big size, 10,000, 20,000, 30,000 or more, well, every penny starts to really add up. So getting good fills is important. And that's when you start using dark pool routing to see if there is some hidden liquidity available. Now, in addition to looking at your standard level 2, just to the right of level 2, you have your time and sales. All right. So time and sales is showing every single transaction that occurs, and it's going to list information about that transaction, the price, the shares, the route, and the time. So if we look here, we'll again at this example that I've got on my screen, we've got AKAO, this is our level 2, and over on the side, we've got, this is our time and sales. Now I can choose, let's see, I can choose which columns I want to display. Where is it? I guess it's just properties. And I can show more information if I want to see more information for whatever reason. For me, the price and the size is more than enough, but you can choose to show the routes, and you can show some other things as well. For some reason, I can't remember where to change the oh, maybe it's right here, trades only. I don't know. In any case, there are some things that you can do to see more, but in any case, what you're looking at here are transactions. Transactions that are red are occurring at the bid price, right? Now, even though this would be considered, red, it's a sell, you're selling to someone who is buying at 59. So even though this person is selling, someone else was buying. But we consider it red because it took place at the bid price, and it's showing weakness. Green orders are at the ask price, and white orders are in between the spread, okay? So just by looking at the time and sales, even if we decided not to look at this at all, just by looking at this, we can also start to interpret market sentiment, right? We can understand there's lots of buyers here or there's lots of sellers here. And this is called tape reading, learning to read the tape. Right here, we've got a little bit of a batch of buying going through, a lot of buying, a lot of green orders. And you can also look at the order size. How big are these orders? Is this large size? Is someone really accumulating a large position, or is it smaller? So we had a little batch of buying there. Now we've kind of shifted to a little bit of selling. So this is also an important tool, and it really goes hand in hand with level 2. Level 2, you'll see all these numbers moving, but these go together, right? When this goes from 100 to 0, it's because someone bought 100 shares. right? When this goes from 600 to 0, it's because someone sold 600 shares. So this helps us understand what's happening on both sides with the level 2 and the time in sales. All right, and this also is a visual representation of the volume that's occurring on every single candlestick, right? This is volume. These are transactions. These are shares that are being traded. And on this stock in the last 5 minutes, we've had 580,000 shares of volume. So 580,000 shares have gone through right here. And that helps us understand for sure if this stock is being thickly traded or if it's being thinly traded. And you could look at a stock, for instance, again, I'll go back to Bank of America. This is a stock that, trades tens of millions of shares of volume on most days. It's very, very thickly traded. Whereas a stock, let's just say PAC B, for instance, this is a stock that today has only traded 480,000 shares. Really hasn't traded that much. The level 2 surprisingly looks fairly thick, but this is a pretty thinly traded stock. OPTT, look at this one. This one's also a pretty thinly traded stock. You've got more space in between the intervals, 8, 10, 12, 14, 15, 18, 34. So this could move up to 34 fairly quickly or down to, maybe even 288 fairly quickly. This is a stock that in the past has made big moves from $2.50 to $6, right? So this is a stock that has the potential to really open up. Now, the way I look at level 2 is this sort of traditional way. This is an E-signal, and then the examples in the slide when I start showing you live examples are on Speed Trader. And this shows you the bids on the left and the ask on the right. Now, another way of displaying this is the way TD Ameritrade does it, which is it's all in one column. Now, this is interesting because this shows you the bids on the left and the ask on the right, but it shows you the price in a line, and this kind of helps you see, in a way, where we have resistance, right? We have resistance coming up at, at a certain price. Let's just put up a chart here, AKAO, for instance. This one we've kind of been watching. So we know this is probably going to have some resistance, up in the 90s. So if we saw, for instance, a 10,000 share order at 90 and maybe a 100,000 share order at 16, we would think, okay, I'm seeing resistance. I see it on the chart and I see it visually here in the orders, that someone has a big order to sell up high. So this is kind of an interesting way to view level 2. But for me, I don't like viewing it in this way because I just personally find it a little bit difficult to read because of the way it's sort of jumping around here. It's just not as easy. This, to me, is easier to read and easier to understand. And that may just be because I've traded with this type of level 2 for a lot longer. All right, so now that you have sort of an understanding of level 2 time and sales, I'm going to show you a few examples here of me actually trading in real time. So these are recordings that I took at some point over the last few months. And you can see here, this is a stock, ORPN. Now, on this one, we're going to be looking for big bids and big sellers. All right. Now, I get in this in anticipation of the break of the whole dollar. I like to buy stocks at whole dollars and half dollars. So I've got an average here of, looks like 4 something. I've got a pretty good average on this one, actually. But I added here for the break of $5 and looking for that squeeze over the whole dollar. This is ORPN. All right. So one of the things that, you can see here is we've got a fairly big spread, 70 by 90. That's a 20-cent spread. So just in between that spread with 10,000 shares, you've got $2,000 of potential profit. That can be a little bit difficult to trade when you have stocks that have big spreads. So when we have a big spread, I always try to sell at the ask price. I try to get the best price I can. That means I put an order, like I have right here, to sell at $4.99, knowing that when people start buying, that order will get filled. So waiting for people to buy at 99. Now, if no one buys, see, someone just bought and I got filled at 99. So got my fill on the ask. If no one buys, then I can also just cancel that order and sell to someone who's already showing they want to buy on the bid. And that's what I did there. I just flipped out and sold, I think it was half at 87 on the bid. And I do that from time to time because of the fact that look at how fast this stock just went down, 45 cents, right? That's pretty crazy. I sold the rest at 455. That right there is volatility. And what this represents also is an opportunity. This is a stock that has the potential to move very, very quickly, right? In the right circumstances. So this is a stock that had news. This is a stock that on this day and right between these two trading accounts, I'll make over $5,000. Now, the reason I was trading in two accounts is because this month I started a $1,000 trading account over on the right-hand side. And then I also had my regular trading account. So with the small one, I was seeing how quickly I could grow a $1,000 account. And at the end of this month, I had made $7,653. So 763% gain in 1 month. And then the problem, of course, is that trading with a very small account, I couldn't really make a lot of money. So when I saw really good opportunities, like on a stock that I thought could move 100%, I would trade it also with my regular size account. Now, one of the things that we're going to look for on this stock is a really big bid. This big bid is going to show us some market sentiment. It's going to show us a strong level 2. And so when we see that big bid, we realize that either someone is putting out a really big order, to buy this stock, or potentially someone is short and they're trying to cover that order. And the only way you cover orders is by buying. And when you've got a stock that's up 100%, this is up 100% right now, anyone who's short from yesterday is down big time, right? So this is the type of thing where those people may just start to cover and just throw in the towel. In fact, their broker may even be covering for them because they've hit a margin call. So when brokers do that, they're just going to mark it in, they're going to just unload, and then you see more buying. That's what creates that imbalance between buyers and sellers. Not only do you have buyers who just naturally want to buy this stock to get a piece of the action, you also have buyers who are covering short positions. So that multiplies the number of buyers, and that creates an imbalance between buyers and sellers. When you have an imbalance on this type of stock, you can get extreme moves, parabolic moves. And again, this represents an opportunity for day traders who know how to capitalize on these types of setups. All right, so we're watching this, trading kind of between 480 and 540, which is a really big range. Now, one of the things I'm going to fast forward this that we're going to see in a moment is we're going to see a pretty big bid show up. Now, let's see, where is this guy? It's going to show up at 510. It's going to be an 87,000 share. There he is, 87,000 share buyer. See that? That's a pretty big order, right? That's a very large order. 87,000 shares of a $5 stock. That's a lot of money. So this is a person, putting out an order for, almost $500,000 in stock. That's a big order. Now, we don't know if this person is short and trying to cover, or if they have a long bias and they just genuinely want to buy this stock. We're not really sure what's the exact reason behind the order, but we can look at that as a very strong level 2. This is a very strong, buyer here. This is someone propping up the stock, essentially. So we'll watch this for a couple more minutes here. Let's fast forward. Now, we come down, we test the buyer at 510, and he holds, right? He's not moving. He's not budging. So we test support. Support is solid, and then we bounce off that level and start to surge up. And this stock is going to squeeze all the way up to $6, right? It's going to be up about 140%. Now, what you're going to see here in just a moment, let's see. There we go. Now we've got a 180,000 share buyer. And see how as soon as I saw that, I pressed the buy button because I knew that meant this stock could go to $6. When you see someone putting out an order to buy 180,000 shares of stock, that's a big deal, right? Now, again, remember, someone who's just looking at level 1 data, they don't even see this, right? They're at such a disadvantage. They don't even recognize. So now I've increased my size. I'm looking for this to break out over $6. And I'm also keeping my eye out like, okay, oh, here he is. He's popped back up and he's at 75 now with 37,000 shares. So there is someone with some really deep pockets who is propping up this stock. Whether he's buying or covering a short position, we're seeing some extreme volatility. So you can see right now I'm up about $2,700 in this account. In this account, I was down 1,000. And look, he's propped up now. He's at 610. This guy keeps moving it up. It's pretty incredible. If you weren't looking at level 2, you wouldn't see any of this. Now, remember, we're only looking at this stock because it has a catalyst. Now he's up at 20. Now he's up at 30. He's going to move up to 650. I mean, think about how quickly the stock is moving. We're up 145% right now. So now he's there at 650, 655, 670 on the ask. So again, we've got a little bit of a spread. I would try to sell on the ask if I could. And this is a stock that's going to just continue to rip higher and higher. We get up there, $7, right? We're up 150%. Okay, so that's the importance of being able to read level 2. When you can read level 2, you can start to interpret market sentiment. Now, just the way we're looking at these big bids here, if we popped up and we saw a really big seller, we saw a 160,000 share seller, I would bail out of the trade. I would get out of it. I would sell. I'd be like, no, there's someone holding it down. And I don't want to be in this stock while we've got someone holding it down. But in this case, we've got someone on the bid, propping it up, and that's providing us support. And that can effectively create a short squeeze where all you have are buyers, you don't have sellers, and that's when stocks can go parabolic. So when we talk about stocks going parabolic, we have to, at least just for a moment, look at DRYS. This is a stock that went from $4.50 to over $100 per share in 1, 2, 3, 4 days. That right there is potential. That's an opportunity. Let's look at RGSC. This is a stock that in 2 days went from $2 to $8. These are stocks that just explode. And this represents an opportunity where traders who were smart were able to capitalize and make tens of thousands, if not hundreds of thousands of dollars. But every time we take a trade, we're looking at the level 2. We look at the level 2 to understand, is this strong? Do we have some buyers, or do we have a big overhead seller holding it down? This helps us understand the current market sentiment. All right, so let's look at another live trade here. This is going to be a 100K share, 100,000 share seller holding down the level 2. All right, so we're looking at this, kind of squeezing up, looks good, and we're going to see him down here. And as soon as we see him, it's like, forget about it, get out of the way, don't want to still be long this stock. CPXX. So right now it looks okay. We've got 4-cent spread. Looks like it could really move. I'd be thinking $12. I kind of look at this as like stocks in $half and whole dollar increments. Those are targets that I usually put on them. So 11.50 to 12, 12.50 to 13. So right here, 11.70, 11.73. Oh, there we go. Look at that. 11.75. See that big seller? That is not what you want to see. A 100,000 share seller, we're not going to be able to break through that level. I mean, we could, but we would need 100,000 shares of buyers to take out that order, right? So when we see that type of thing, usually traders who see that just start to sell. They get out of their position. They say, forget about it. And so look, the stock is starting to dip. Now, if you were just looking at level 1 data and you were just looking at the chart, maybe you'd be selling now at 63, or maybe at 60 or something. But because I'm looking at this level 2 data and I saw that seller right away, I had an opportunity to get out sooner. That's part of what gives me my edge as a trader. All right, so let's see. Let's look at another example. Here we go. We've got trading in the Sure Trader account. Let's see. Which one is this? All right, so here we're going to see a 17,000 share seller. Looks like it's 22,000 at 217. All right, so we've got a seller at 217. And sometimes when we see those sellers, if we see them start to get taken out, where we see, so I just got in at 207, I'm long the stock. When we see at 217 and it goes from 20,000 to 18, 17, 16, 15, 14, 13, 12, 11, 10, 9, and it starts to get bought up, I will buy just before it breaks because I know statistically that we get a quick snap. As soon as we break over that level, we get a quick pop. And that's exactly what's going to happen here. And again, if you were just using level 1 data, you would never see this. But this is an opportunity right here where I'll be able to make a quick little profit. So I'm watching. I've got my order ready at 18. Okay. So we've got 17 on the ask, 20,000 shares. 17,000. All right. Now we're going to watch this. We're going to watch the buyers. Okay. We dip down for a second. 17,000. Still on the ask. Now 12 by 16. Are we going to get some buyers to come into this? I've got my order ready. All I have to do is click the buy button. No confirmation. 17,000, 16, 15, 14, 12, 7. I double, and now instantly I'm up almost $100 on that position, right? Now I've got about $400 unrealized profit. I put my order I'm ready to sell on the ask. I put an order there to sell, looks like at 29, something like that, putting out orders on the ask. So now I'm going to be up here in the stack, right? If the stock continues to squeeze up, I'll start to get out. Sold 1,000 shares at 25. Right, I've got another order out there to sell some more. So I can put my orders out there as well. Now, what some traders will do, there we go, there goes 2,000 more shares out at 25. And I sold the rest, taking the profit. So GBIM, looks like it ends up being $200, $250, which is not bad. And this is thanks to being able to see level 2 data. So when you're looking at level 2 and you're trading level 2, it can get into scalping, right? Very, very quick trades. But it can also be long holds where you're just waiting for an exit indicator and you use level 2 to try to find that exit indicator. And this can also be just simply what you use to get into the trade. And then once you're in the trade, right, and you feel confident in the price action and the market sentiment that's being displayed on the level 2, you set your stop at the low of the pullback. Now that entry there, you can see at 207, that was the first candle to make a new high, stop at the low of the pullback. This is a 5 minute, this is 1 minute, and then the 5 minute was over here, a bull flag, right? Very simple pattern that we see all the time. So it's not a coincidence that at the breakout point, there was a seller. Sometimes you have some resistance at the breakout points. And sometimes that resistance holds and we can't break, as we saw in the last example with a 100,000 share seller. And other times we break and then we pop up. All right, so this one here, we're going to see another example. Let's see what this one is. All right, so this is a stock that is halted. All right, so we've got a stock halt. Now, if you're interested in circuit breaker halts, we also have a great terminology video where we talk all about circuit breaker halts and I show you some examples. So this is a stock that was halted. We've got a pretty big spread, as you can see. All right. Pretty big spread, 167 by 168. Now, this stock is up 240%. I put out an order to buy, and I filled 900 shares right here at 67 and 68. Even though this is about to get halted right here, sometimes just before the stock gets halted, you have an opportunity to get in. And so I now have 1,400 shares from 167. This just squeezed up and got halted again. Now we're at 195, right? So holding still. Now, when stocks get halted, there's nothing we can do. We see this very thick level 2, nothing we could do about it. These are stocks getting halted on circuit breakers. They're moving, they're exceeding the volatility that they're allowed within a 5-minute period. And as a result, they get halted for 5 minutes. All right, now here we go. This is a stock that is right now up 416%. So I've got my order to sell some on the ask. There we go. Sold some on the ask at 250. It's a pretty thinly traded stock, but you can see even right here, 47 by 55 is not a bad spread. 54 by 55. And now right here, we're about to get halted. Okay, so we're outside our volatility bands, which gives us 15 seconds. If we stay outside for 15 seconds, the stock will be halted. And now we've got a P for pause. The limit up, limit down, volatility halt. All right, so this is now paused. And I've locked up $870 and I'm still holding 300 shares from $1.67, which is pretty ridiculous, right? $1.67. I'm going to be up almost 100% on that position. All right, so let's see. Let's fast forward this. Oh, here we go. All right, so we are going to resume here. And it looks like we might drop for a second. And anytime this stock moves more than 10%, it will get halted, right? Right now, we're working with, looks like 10% circuit breaker halt. So we go up 10%, we get halted. We go down 10%, we get halted. So I sold the rest of that position. It's a $1,000 profit. And being able to trade stocks that have just been halted is all about reading the level 2. If you can't read the level 2, if you can't see those big sellers or those big buyers, you can't trade them. So that's another really important value in being able to read level 2. All right, and now here we go. Let's see which one this is. This is OPTT right here up in the top, and I'm getting in this here for the break of $3, right? So this is my whole dollar breakout. I love getting in for $3 rolls, $4 roll, the whole dollar break. So I'm long at 290 with 2,800 shares. I'm right now up on the ask about $600, but I'm holding, still holding the position, thinking that this has more potential, more room. You can see here how quickly it goes from up to break even. Quickly, we had a bid there at 17, which is certainly nice to see when you've got a big position. Now we're 23 by 40, right? Okay, 28 by 45 on the ask, 44 by 50. I just added. Why would I do that? I'm adding because I see the strength. Now I recognize potential. I'm seeing that lots of traders are jumping into this, and this could squeeze up to $4. Look at that. Now see how I'm selling a little bit right here at 78, selling 3/4 of my position, locking up 2,400. Now I've got $2,929 of profit. Right here at 84, we're outside. It looks like we're just about to get halted. We're getting outside those volatility bands, and now we've got $4 by 425, 403 by 425. So we're right on that verge of getting halted on a circuit breaker. Now, stocks in the first 15 minutes have looser thresholds before they'll get halted. So that's because the market has peak volatility in the first 5 minutes, and so it allows stocks to be more volatile. See what the level 2 is doing here? It's pinned at 25. This is going to get halted. And of course, in hindsight, if I'd held the whole position, I would have certainly done better on this trade. But you have to have a strategy for trading. And my strategy is that once I have profit, I start to take some off the table. Sometimes you end up kicking yourself for it when stocks like this end up running, my entry is 315 and this stock, it just hit a high of 489. But look at how fast it came back down to 380. So I sell into strength. You can never know exactly where the top is, but I try to put those orders out on the level 2, sell into strength. Now on this one, I ended up adding for the break because I saw a big buyer. Now let me actually just rewind that for 1 second. Let's see. This was halted, dropped back down, and then the first candle to make a new high, I'll get back in over the $0.50. Loving those $0.50 entries. Okay, so I'm ready to go. Watching this here. Watching the bid. Let's see. I'm going to be looking for the first candle to make the new high here. And then first candle to make the new high and then move right back up towards high of day. So I've got my order ready. So I'm not sure if I fast forwarded this or I rewound this. Or was it? Here it is. Okay. So right here, when we pop back up and we see this, I start to add for the $0.50 break. And now we see a 10,000 share buyer right here, 10,000 share bid at 52. And look at how that's flashing. I've got orders out to sell at 94. This hit high a day and I was able to flip out orders at 94. And I'm up $4,365 in 10 minutes of trading. That's more than most Vermonters make in a month, really. And to make that in 12 minutes is ridiculous. Level 2 is a huge part of that. Imagine trying to do that without this tool. Just looking at the charts, you wouldn't be able to do it. This is so important. Learning how to read level 2 is what can help take your trading to the next level. But remember, level 2 is a tool, and we use it specifically on certain types of stocks. So whenever we're trading, we have to come back to, are we trading the right type of stock, right? And if you're not trading the right type of stock, then obviously that's a problem. We need to focus first on the right type of stock. We need to focus on managing risk, making sure that you understand every trade you take carries risk, but you can reduce your risk by only trading the strongest setups. I focus on a 2-to-1 profit loss ratio, so that means I risk 100 to make 200. And sometimes I risk 1,000 to make 2,000. Sometimes I risk 2,000 to make 4,000. On my best day this year, I made over $10,000. My best month was a $34,000 winning month. So sometimes I do increase the risk, but it's all because I know I can justify the risk, right? I risk 1,000 to make 2,000. It has to have a reasonable profit-loss ratio. You understand risk. You understand how to choose stocks with home run potential, the stocks that are lower float with a catalyst, with breaking news, and with super high relative volume. Thousands and thousands of traders that are looking at these stocks. And then you take your entries on the bull flags, the flat top breakouts, you set your stop, and you hold it as long as you can. You watch the level 2, you look for those early entry signals, those early exit indicators, and at the end of the day, if you have the metrics to be profitable, then you can do really well as a trader. In the last 12 months, I'm up just over $200,000, about $210,000, and it's trading 2 hours a day. Now, all the students that we work with, we put them on our trading simulator, and the reason we do that is because we want to watch how they're trading. Now, learning to read level 2 is something that takes time, it takes practice. The best way to practice trading is trading in a safe environment, right? When you trade in a safe environment, then if you lose money, the losses are not real. Having that period where you can practice, it's invaluable. If I had had that, it would have saved me over $30,000 in trading losses that I incurred during my first 18 months as a trader. So in our simulator here, I can log in and I can see what our students are doing. I can actually look at their trades and understand if they're making good decisions or if they're making bad decisions, right? Whether they're holding positions from yesterday, whether they're taking too much risk and that sort of thing. Now, we also allow them to go and actually see all of their stats. So let me pull this up here. They can go and they can look at their statistics, because once you're practicing, you need to understand, well, where what are my metrics right now? Every trader who's trading has metrics. So you either have metrics that are sustainable and that will allow you to be a profitable trader, or you have metrics that are, the metrics of a trader who's going to lose money. Metrics come down to your accuracy and your profit-loss ratio. If you have good profit-loss ratios and you have good accuracy, then you can be a profitable trader long-term. So we look at your metrics, and then we understand, based on how you've been trading in this simulator, for the last 30 days, if you'd been trading with real money, would you have been profitable? And once you have, 2 months under your belt where the answer is yes, then you're ready to transition to real money. So during the first 90 days, you're watching level 2, you're trading side by side with me, right? You're looking at all of these same things. The only difference is that all of your trades are practice. And then when you log in and you want to check your stats, you can log in, you can see your metrics, and you can understand, over the last 30 days or whatever it is, what were you doing right, what were you doing wrong. So you can understand your average daily volume, your win rate, your profit loss ratios, your average losing trade versus your average winning trade. This level of insight, really, for a beginner trader is invaluable. This is what tells you what you need to focus on to get better, right? This gives you that feedback, that direct feedback. And I wish even my my live brokerage account had this, because it would be so interesting to be able to see my metrics, through reports that they offered. So, I just wanted to touch on this because as traders are looking up terms like, level 2 and market makers and dark pools and stuff like that, inevitably 90% of traders will fail. Okay? You have to realize that. They fail not because they're not trying hard, but because they lack the strategy, the framework, and the support to trade profitably. Okay? So trading profitably, it is an option. All you have to do is focus on your metrics. Focus on one strategy. Learn how to choose stocks with home run potential. Learn how to manage risk. Learn how to use the tools like level 2, like your hotkeys, and then you're going to be well on your way to being a profitable trader. All right, guys. So I hope this has been helpful. This is a long day trading terminology session here, but I'm sure that you guys got a lot out of it. So if you have any questions, please email me, ross@warriortrading.com, or put your comments down below. All right, thanks guys.
Let's be honest. If you made it this far, you must have really enjoyed that video. So what's stopping you? Subscribe right here and get email alerts anytime I upload new content. Until then, happy surfing